The third and final stage is 750K to $1 million plus. So we've gone from experimenting to growing. Now, my friends, we're scaling. Our third and final stage of scaling is when we are pouring gas on your business. What do I mean by gas? I mean that we are now pouring gas on your marketing and sales efforts to now exponentially grow the number of leads and clients that you're serving. So by the time you get to scaling, your foundation is set, you've built your systems, you've built some infrastructure, you've built your team, to now we can pour gas on each part of your business to multiply the number of people you're impacting and serving. So this is what I name for folks, because often folks use the word growing and scaling interchangeably. And I'm like, if you're not ready to pour gas, you're not scaling. Because if you pour gas too early, you will break your business. And that's a natural part of growing your business, because what I've learned is you have to break your business in order to grow. And that's an indication that you're growing, is when your business starts to break. And what I mean by that is that your systems aren't working efficiently and you've got to upgrade your systems or you got to refine your systems. That's going to be an iterative, cyclical process that happens over and over and over in your business as you keep growing. But at the scaling stage, we're pouring gas, meaning if you are used to 5 leads coming in a week, we now want to pour gas. And what if we send you 50 leads a week? What if we send you 100 leads a week? What if we send you 500 leads a week? Your business shouldn't break because you did the work needed in the growing phase to set you up to multiply what's coming into your business. So at this scaling phase, this is where it's really critical, where you're going to go through an identity shift to being a CEO. Like, you're going to go from a client delivery person to now you actually have to be the CEO of a company in the scaling stage, because now your team is starting to grow. You now might have the beginning, early stages of departments. You might have an operations team. You should, at this point, have an executive assistant who is full-time to be able to support you effectively as a CEO. You might have some finance team. You have a legal person who is your go-to and your contact for legal matters. So your org chart has now started to create branches at this stage because you're building a company. That's scaling. Scaling is when we're doing more of what's already working to be able to grow our impact. So this scaling stage is really important because, like I said, you're shifting your identity to a CEO, which means now you're thinking about HR, you're thinking about finance differently. You have a CFO now that you've brought on board to help you predict your cash flow, to help you look forward in your business. You now have more than just a VA. You should have more than a VA at this stage. You are building a company. You are now have a not only a bookkeeper, but you actually have financial systems and processes in place to help you monitor the financial health of your business. The scaling stage is all about becoming the CEO that your business needs. So those are the 3 stages of business. And I'd be curious to hear from you in the comments, given that level of clarity, what stage of business are you in? And then given what we talked about and shared, what is sticking out for you in terms of your area of focus? Did I say something that sparked a light bulb for you? Did I give some meaning to what you were feeling or experiencing? Let me know in the comments around what's sticking out to you when you hear these stages of business. And it's important, again, that we have this conversation around the different stages, because if you are seeking advice online around, well, who should I use for my email provider? The answer is different if you're experimenting versus you're growing versus you're scaling. I would have 3 different answers. And the people online aren't going to ask you what stage of business you're in. They're just going to tell you what they use. But you don't know if they're experimenting, if they're growing, or if they're scaling, right? And I can bet you 9 times out of 10, the people giving you answers are experimenting. And so if you are growing or scaling, the internets are not the best places for you to be getting recommendations, because people don't know what stage of business you're in. And likely people who are giving you that advisement are in an earlier stage of business and they may not have the same priorities that you have. Lastly, the 750K to a million and plus is when you want to be bringing on that CFO, which stands for Chief Financial Officer. So this position comes at a little bit later in business. You don't start with a CFO, but a CFO helps you look forward in your business. It helps you look forward in your finances. So when you think about a bookkeeper or an accountant, they help you look backwards because they are reconciling your past transactions. They are organizing your past transactions, or they're filing tax documents for your past financial actions, versus a CFO helps you look forward. They help you look at predictions. They help you look at projections. They're looking at your cash flow to help you determine, do you have enough money on hand to be able to hire that position that you want to hire in the next 3 to 6 months? Given the amount of cash that you have on hand and given the trends and patterns in your business, how much cash do you have to last you for how long? So you might have a cash flow projection of you have enough cash on hand for the next 3 months. And so what needs to happen in the next 90 days for you to keep having cash on hand to keep moving in your business? Or they're looking at what are some of your upcoming business activities, and let's help you predict what cash will be coming into the business. What are your upcoming expense obligations? So they're helping you predict what is the future financial state of your business to help you take action now. A CFO is really critical when you are at the 7-figure mark and beyond. And oftentimes when people hear CFO, they hear a full-time position. Most businesses who start with a CFO relationship are not hiring someone full-time. They're usually starting with a retainer relationship where you retain a CFO professional to help you in that area of your business. And I think it's important to name that a CFO is not the same as an accountant, which is not the same as a bookkeeper. They could all be different people, and sometimes these people play in the same sandboxes. So there are some accountants that will attempt to play in the CFO sandbox when actually they're accountants. And so this is why this knowledge is so important, because you have to know the role of every single professional on your team to be able to know when someone's not playing their role appropriately for you to be able to manage them appropriately. So there are some accountants who might say they're bookkeepers, or some bookkeepers who might say they're accountants, or some tax strategists who might say that they're bookkeepers, and they're actually not. So this is why knowledge is so important, for you to be able to know if this is the role that you say you play, this is what I should be expecting. And the moment that that's not happening, that's when you need to have that feedback conversation. This is a part of the hidden curriculum that we don't talk about when it comes to wealth. And this is how we have situations where, because I tell my clients too, where it's like, there are some of you all who are earlier stage in business who are paying more in taxes than I am.
Yes.
Because of certain tax strategies that now become unlocked when you either reach certain levels in business, but also when you're actually strategic with certain assets. Because again, the only tax strategy that exists is the tax strategy that exists, it's bigger than just we'll spend down or buy a G-Wagon. Like there's more to tax strategy than both of those. So just to make this plain for folks, because what you're saying is that, okay, at the end of the year, if I have made $1 million in my business and first off, we're not tax professionals. So do your own due diligence.
Build your team.
And build your team. And for the sake of this example, and we're going to do an experience share where, let's say we had $1 million business. And, when it comes down to our own personal situation, we had $250,000 of taxable income. And you're saying that when we have real estate is an asset that which the government is giving us an incentive and saying, we're going to give you tax breaks to where you can reduce that $250,000 by certain amounts.
Yes.
You can also write off different parts of your real estate assets, whether it's actual expenses. So I know that when I had a change in tenant in my Charlotte house and they did they left my house a mess.
Mm-hmm.
And it took me, I had to pay $10,000 to actually get it ready for the next tenant, but I was able to write that off.
Yes.
Because that's an expense associated to the property. So if I had $250,000 of taxable income, now I'm writing off $10,000.
Yes.
And what you're saying with the cost segregation study is that now there's different pieces of the building that I can depreciate faster.
Yeah.
So it could be at a 5-year rate, a 10-year rate, whatever. Yeah. But this is why having a financial team is so important.
Yes, because I don't know how to do that.
We don't, right.
Hire someone to do that. And
right.
That's all that they do.
But that's how someone who started off with $250,000 of taxable income can now get zero or get a refund.
And do you know why they want to do that?
Why?
The reason why they want you not to pay a bunch of taxes, because they want you to make more money so that you continue to invest. Because if you continue to invest, then you continue to provide housing, and that continues to make the U.S. economy stable.
So I'm like, this is why, and I appreciate you naming the story of like, I was so afraid to invest bigger, but when you invested bigger, now like you have all of these incentives and like I think that is a great example of like the wealth building journey where it's like the bigger you can play, the action, like we live in a country that actually will incentivize those big plays.
Yes.
And so they feel really risky on the surface.
Yeah.
But like when you can tap into it, you can execute it.
Yeah.
You actually are better off for it. And you're actually in a position to where you can continue to help make your money grow.
Right.
When you move into the scaling part of your business, we're now talking, we're pushing the 7-figure mark, if not already crossed the 7-figure mark. This is where we are moving from narrowing who we partner with to now we're being more selective. Because now it's not just a matter of what's a great use of my time, but now it's a matter of assessing liability because I got shit to lose now because my business is now making significant revenue. I now have a team. I'm now in paying salaries. Like I have a lot of things to lose that if this partnership doesn't go well, the impact is felt a lot differently when I have 7 figures of revenue versus when I'm experimenting and maybe I just hit my first 6 figures, right? Like I can afford for a partnership to not go well if I'm at the 100K mark versus when I'm at the 7-figure mark. Because if a partnership doesn't go well, 9 times out of 10, I'm losing money at the scaling stage versus experimenting. I might have just lost some time or whatever, but I'm gonna keep pushing. I really didn't lose any revenue. So at this partnership stage, at the scaling phase, you have got to be really clear on who makes sense to partner with. And here are a couple of criteria that I think about. The first thing that I think about is, do we share the same audience and they solve a different problem? So that criteria we had in the growing stage and that still exists in this stage. And then secondly, I think about, okay, what is their actual reach in terms of audience? Because if they only have an email list of 300 people, if they only have a social media following of 500 people, that's actually not an effective use of my time from a partnership standpoint. How often are they sending emails? So if we record a podcast episode together, will they even share it with their email list? So if they're not emailing their email list, that means that I'm not actually able to effectively partner with them and tap into their audience because they don't even email their list, right? So those are some of the questions that I would start asking to get more clarity on not only what their audience size is, but how are they actually engaging in their audience? So that way, this actually becomes an effective partnership, right? The other thing that I think about is what is the values of the other person? And are we aligned in our values? Because the liability that is presented when we are not aligned in our values is now I am risking my reputation. And when I'm aligned with a partner who we have different values, then now I've actually created a very big risk for me and my business. So let me give you an example. If I partner with someone who, let's say, has very different political views than I do, right? And that might be individually, but business-wise, some people might think of them as separate, but given me and my brand, my target audience is Black educators. And if you have particular views that don't align to the social equity and justice cause that is baked into my business, given who I serve and who I show up to, that actually is creating a risk for me. We ain't gonna partner together. I don't care how great of a person you are. I don't care how much we could chit chat. I don't care if we had great drinks at the bar. We are not going to partner together because you are now creating a risk for my business. So those are a couple of things that I think about when it comes to partnerships at the scaling level. And the last thing that I would just name here is when we're thinking about partnerships and you're now at the scaling level, assessing what is the human capital capacity that the other person has in their business. So to be frank and to make this clear and plain, that now at the scaling stage, you can no longer afford to partner with someone who does not have a team. And the reason why that becomes a risk is because that person without a team is one life event away from their business pausing. So if they get sick, if they have an emergency, if something happens with their family, God forbid, if someone passes away, or if there is some significant life event that happens and they have to take time off from their business and there is no one else there to be able to carry the work forth, now your partnership is on pause. And if we were doing a joint venture webinar together, now we might have to push back the date. Now we might have to redo the marketing plan. Now we might have to completely change our plans because you don't have a team. And now you just cost me time and money, right? So those are the things that I think about, because one of the things that I didn't realize as I was growing my business is how the liability of partnership increases as your business grows. And I've had experiences where I've partnered with people who don't have teams, and me wanting to support their business, them having a solution that they can offer in my business, and then something happens in their family and they cannot show up. And now my business is on pause, and it's just annoying, honestly. So here are a couple of things to be thinking about, some structures to put in place, some boundaries to put in place as you're navigating these partnerships. And even if you're not at the scaling phase just yet, these are still things that you want to be aware of, so that way you can either backwards plan from it, or you can start laying that foundation now in your partnership, such that you can grow into these strategies that I'm going to share with you. So first, when it comes to partnerships, when you are at the scaling phase, your partnerships now need to have contracts, meaning you need to have partnership agreements. And that is the opportunity for you to clearly lay out all the expectations of the partnership. Is there an expectation of time? Is there an expectation of revenue? Is there an expectation of a revenue split? Is there an expectation of communication? If we are partnering together for a joint venture workshop, whose account are we creating the webinar on? And who's accepting the money? And who is then having to pay out, and what's the date in which the payout has to happen? And what's the split of the payout? Who's sending the emails? Who's running the ads, right? All these things, right, that you don't think about until you now get into a partnership and something happens, and now you realize, oh, that person missed a deadline, so ads aren't running for your joint venture, and now you've potentially impacted the number of registrants for your webinar because the person was late starting the ads, right? So your contracts are the perfect place to outline all the expectations of the partnership and make it crystal clear and black and white from jump of how you all are going to engage in the partnership. When you do not have that document in place, you have now set yourself up for a liability, and you've set you up for a potential headache if something doesn't go right. Secondly, ask for data. When it comes to the partnership, ask questions. Ask them how many people are on your email list. How many times a week do you communicate with your email list? What's your social media following look like? How many times a week do you post? When's the last time that you've gone live? If you're asking me to be a podcast guest, well, how many downloads did you have the past month? What platforms are you on? How many times do you email your list about your podcast? How frequently do you drop episodes? When's the last time you posted an episode? Because don't ask me to be on your podcast and you ain't posted in 6 months. Right? Because now you've impacted the listenership of the podcast to where it may not be the best use of my time if you're only getting 5 downloads a month on your podcast, right? That's not going to be the best use of my time to be able to show up and spend time recording the episode when I could go and find 5 leads on my own, right? So ask about the data, and a real authentic partner who's really about that action and about that partnership will have no problem being transparent with those numbers to be able to state their case of why the partnership will be beneficial for both parties. And then lastly, you have to be willing to cut partnerships quickly that are not serving you.